Good morning, everyone, and welcome. I'm so glad that you could all join us for the What OBBA Means for Your Business. I would like to start with a quick introduction to DHJJ. We are a full-service CPA firm and business advisory firm serving businesses and individuals across the Chicagoland area and all over the country. Our team works closely with business owners, executives, and finance leaders to provide tax, audit, accounting, and advisory services that help clients make confident decisions. Today, you'll hear directly from the DHJJ tax team leading our efforts on the OBBBA. They've been immersed in analyzing the challenges in this sweeping new legislation and what it means for businesses like yours. We are fortunate to have two of our principals, Maria Hernandez and Ryan Stewart, joining us today. They'll be part of the panel during the Q&A at the end of our session. And now let me introduce our speakers who will take us through today's presentation. First, we have Vicki Marsh, Senior Tax Manager at DHJJ. With over 25 years of experience in public accounting, Vicki specializes in comprehensive tax strategies for both individuals and businesses. Throughout her career, Vicki has been dedicated to staying at the forefront of tax law changes. Her deep understanding of federal, state, and local tax laws help clients optimize their financial position and minimize liabilities. We also have Jamie Jagodzinski, principal at DHJJ. Jamie specializes in business tax strategy and consulting, particularly around entity structuring, mergers and acquisitions, and succession planning. He has a strong focus on interpreting new tax laws, including the OBBBA, and translating them into actionable steps for business leaders. So before we dive in, a quick note on today's format. After the presentation, we'll have a Q&A session. So we'll start with some of the questions that you all submitted ahead of time, and then we'll move into some live questions. So throughout this session, if something comes to mind, please drop your question in the chat. I'll be monitoring them and we'll bring them up during the Q&A. With that, let's get started. Today's presentation, What the OBBBA Means for Your Business. Vicki and Jamie, you guys can take it away.
Thanks for those intros, Emma. So like Emma said, we're going to be talking about what the OBBBA means for your business. Now, Vicki is going to be getting into a lot of the rule changes, talking about individual provisions, business provisions, some of the rule changes, the timing, and things like that. And I'm going to get into some of the planning opportunities, discussing, we have a lot of opportunities. There's a lot of business-friendly provisions here. And there's a lot of opportunities for tax savings out there. So I'm going to dive into some of the things our clients might want to start thinking about now to plan for an optimal tax outcome. So thanks for joining us today, and I'll let Vicki kick us off here.
Good morning. So we're going to get started on some of the business provisions that have been impacted by the signing of the One Big Beautiful Bill Act on July 4th of this year. Some of those business provisions that we'll be discussing are bonus depreciation, the Section 179 asset expensing, qualified business income deduction, or 199A, the Section 163J interest expense deduction modifications, and Section 174 research and development expense versus capitalization. So the first topic we're going to discuss is bonus depreciation. So for taxpayers investing in property, plant, and equipment, bonus depreciation was beginning to phase down. Prior to the passing of OBBBA, bonus depreciation was down to 60% in 2024. The OBBBA permanently revives the 100% bonus depreciation expensing option on qualified property that is acquired on or after January 20th of 2025. There's also the other option of using Section 179 to take full deduction on certain property that is acquired. Prior to the passing of the One Big Beautiful Bill Act, the maximum amount you could expense under Section 179 was $1,220,000, and the spending cap was $3,050,000. The OBBBA has increased the maximum to 2.5 million, and the phase-out threshold has been increased to 4 million. And these changes apply to property placed in service in taxable years beginning after December 31st of 2024. There are some you may need to consider then what, now that both are 100% deductions, should you take bonus depreciation or should you take the 179 expense in 2025 and going forward? So there are some differences. So things that you may want to consider, 179 can be more state friendly. So you'd want to look at the state rules and what the various states where you file, what do they allow. There's also some more flexibility in picking and choosing which assets you want to apply the 179 to, whereas bonus depreciation, you have to apply to a whole class of assets. However, there are some limitations with 179 as well, whereas if you are in a loss situation, the 179 gets suspended and can be carried forward, but is not allowed in the current year, whereas bonus depreciation is. And you also must be an active shareholder or partner if you are taking 179. So those are a few items that you would need to consider in determining whether bonus depreciation or Section 179 is a better option for your business. Emma, you can move to the next slide. So another business tax provision that has been impacted by the One Big Beautiful Bill Act is the qualified business income deduction, or Section 199A. So this deduction is a 20% deduction on certain business income, such as pass-through income from partnerships, S corporations, LLCs, and Schedule C income for sole proprietors. The OBBBA has made the QBI deduction permanent. In addition, there's a threshold for calculating the QBI deduction. For taxpayers with income below these thresholds, the deduction is calculated simply by taking 20% of their qualified business income. However, certain limitations are imposed if a taxpayer's income exceeds these thresholds. That's when we need to consider the business's W-2 wages and the unadjusted basis in their assets. For 2025, the threshold for married filing joint taxpayers begins at $394,600. And this threshold is fully phased out at $494,600, which is a $100,000 gap between the beginning and the full phase out. In 2026, with the OBBBA, this has been changed to allow $150,000 span between the beginning of the phase out and the full phase out. So if the phase out begins at $394,600, it won't be fully phased out until $544,600. So next is the 163J interest expense limitation. Under 163J, interest expense is limited for certain taxpayers. The limitation is 30% of adjusted taxable income. So the difference here is how adjusted taxable income is determined. Adjusted taxable income was calculated as earnings before interest and taxes prior to the passage of the OBBBA. But with the passage of this law, it restores the interest deduction limitation back to the earnings before interest, taxes, depreciation, and amortization, or EBITDA. This change is permanent beginning in 2025. So this will allow some companies, some larger companies, to be able to take more of an interest expense deduction beginning in 2025.
So, Vicki, real quick on the 163J,
Yeah.
One thing our clients were facing, this is for clients who are quote unquote large taxpayers, those who have gross receipts over that $30 million threshold. Well, if you think about that EBIT threshold or EBITDA threshold, with these new depreciation rules coming into play with the increase to the doubling of the 179 limit and the 100% bonus coming back into play, throwing EBITDA back into the equation, that 30% limit, it's a significant change. That EBIT change from a couple of years ago snuck up on a lot of clients and significantly reduced their interest expense, especially if you're in a capital intensive type of business, manufacturing type clients, things like that. So this is a pretty significant change and should help a lot of our manufacturing capital intensive type clients.
Right. If you get to add back your depreciation and amortization, that could definitely make a big impact. Thanks, Jamie. So there are some taxpayers that are not subject to the 163J limitations. Like Jamie had mentioned, there's a small business exception. So businesses with average annual gross receipts of 31 million for the last 3 prior tax years would not be subject to this limitation. In addition, electing real property trader businesses would not be subject. If a real property trader business makes this election, though, they would be required to use ADS or the alternative depreciation system for certain property, and then they would not be eligible to claim bonus depreciation. In addition, electing farming businesses and some regulated utility companies would not be subject to the 163J interest expense limitation. And the last significant business-related tax provision that I wanted to discuss is Section 174 and the expensing versus capitalizing of research and development costs. The Tax Cuts and Jobs Act had eliminated the option for businesses to immediately deduct research and development costs for the years 2022, 2023, and 2024. Companies were required to capitalize domestic R&D costs and amortize them over 5 years. And foreign R&D costs were to be amortized over 15 years. The OBBBA permanently restores a company's ability to fully expense domestic R&D costs for any costs incurred in the tax years beginning after December 31st of 2024. Taxpayers may still elect to capitalize in these domestic research expenditures and amortize over not less than 60 months. And the foreign research expenditures must still be capitalized and amortized over 15 years. One thing that taxpayers will need to consider then is the treatment of the 2022 through 2024 capitalized expenditures that are not fully amortized. So any taxpayer is able to elect to handle the unamortized domestic R&D costs from those previous years in one of the 2 following ways. They can deduct the full amount in the first taxable year beginning after December 31st of 2024, or they can deduct the amount pro rata over the next 2 taxable years, beginning with the first year after December 31st, 2024. But if you're considered an eligible small business, you have some additional options available. Revenue Procedure 2025-28 was recently issued, which allows eligible small businesses to apply Section 174A rules retroactively to tax years 2022 through 2024. This RevProc allowed some taxpayers to deduct the R&D expenses on a timely filed or superseded 2024 tax return for 2024 by making a deemed election. If a taxpayer is making a deemed election in 2024, though, they must amend the returns for 2022 and 2023. They would not have the option to expense those in 2025 and 2026. They would have the option, though, if they did not make that election, to take the expense in 2025 or split between 2025 and 2026. Okay, Emma, you can. Okay, now I'm going to turn it over to Jamie so he can discuss some planning considerations related to Section 174.
Thanks, Vicki. So we talked about some of these business-friendly provisions, 163J, changes to our Section 174 costs, changes to bonus depreciation. And a common theme you might have seen related to all three of those provisions are that they're now permanent. So bonus depreciation used to be a temporary provision going back, when bonus first came into play. This 163J and the tax rates in 174, these all had a time limit on them. So with some of these permanent changes, and now gives us an opportunity to see what the tax rules are going to look like around the corner. We don't have a clock on some of these provisions like we did up until July 4th of this year. A lot of those tax provisions that were under the original Trump tax cuts, the TCJA, all had a clock on them. So right now I want to talk specifically about Section 174 planning opportunities. So as Vicki mentioned, if you're a small business taxpayer, your average annual gross receipts are less than 31 million, you have the option to amend 2022 through 2024 and deduct those previously capitalized R&D costs. Or you can choose to deduct those unamortized costs in 2025 or split it between 2025 and 26. If you're a large business, there's less options. You just choose if you're going to deduct them all, those unamortized costs, all in 2025 or split it between 2025 and 2026. So if you're a small business taxpayer under that gross receipts limit and you're thinking about amending, there's some practical considerations that you need to think about. One, there's a time limit on when you can amend by. And so what written within the law is a 1-year due date, effectively related to amending 2022 through 2024. And that date is July 6th of next year. So you have to amend those returns by that due date. All tax years need to be amended. So if you were capitalizing and amortizing costs from 2022 through 2024, then you need to go back to 22, 3, and 24 and amend all tax years. So for many of our clients, we work with a lot of flow-through entities, S corps, partnerships. And so that would mean amending the entity return for all 3 years, and then also amending the shareholder returns, the partner returns for all 3 years as well. So at a minimum, it's 6 years worth of tax returns that need to be amended, say if you're an S corp with 1 shareholder. And obviously that would expand as you add more shareholders and add more than just 2 partners. So think about the cost of compliance too when it comes to amending. There's going to be professional fees involved with amending returns, filing returns, processing the returns, and working with the IRS to get the returns pushed through. And then on top of that, the time to process a return. So filing a return, this is a relatively straightforward change. Once you work through the changes and know what your change in taxable income is, getting the returns prepared and filed is the easy part. Now, getting them processed with the IRS is the difficult part. Now, if you look at IRS guidance as it relates to amended returns, they say it could take 16 to 20 weeks to process an amended return. Now, in practice, what you'll see is 6 months, maybe up to a year to process these returns. When you amend, now the IRS does pay interest, but you'll be waiting 6 months to a year for that refund. So just a few practical considerations when it comes to amending. So then once you're beyond that, there's the tax considerations. If you're a small business taxpayer, you have more options, so it's a little bit more complicated. Now it's less complicated if you're a large entity or you're a C Corp. The big opportunity is around flow-through entities, because ultimately flow-through entity income is taxed at the individual level, and individuals are taxed on a graduated rate system. And so each tax year has a little bit different of a tax situation. You're paying a different rate each year. And then there's some additional considerations, specifically around the R&D credit. So could you go to the next slide, Emma? So we talked about 174, the favorable changes there. Well, a lot of clients who have 174 costs, significant research and development costs, a lot of times they have the R&D credit too. So you might be thinking that, okay, you can go back and amend, deduct all these previously capitalized costs, and then your tax benefit is just directly tied to your reduction in that capitalization amount. Well, it gets a little bit more complicated with an R&D credit. And so how will the R&D credit be impacted if you historically took an R&D credit? Well, under the new rules, there's something called the 280C election. This kind of comes back into play. So under the old rules, you added back R&D costs, amortized them over 5 years. This 280C election wasn't needed in most cases. Well, now that you're deducting R&D costs on amended return, and on a go-forward basis too, if you're continuing on with your research activities, this 280C election comes back into play. And the rules around this are related to double dipping on credits and deductions. So a simple example would be, okay, I took a $100,000 R&D credit in the current year. The IRS would say, without this election, that, okay, well, you got to add back into income that $100,000 credit you're getting, so you're not double dipping. Well, when you go back and amend, this election opens back up. You might be saying, okay, well, why would I want to make this election? Well, this election is available so you can take a reduced credit and not have to worry about that add back into income. So all that to say is, when you're considering amending, you need to consider this 280C election as well. It could have an additional impact on your taxable income, the tax credit you're claiming, and will require some modeling with your tax advisor. You can go to the next slide, Emma. So then other considerations. I talked briefly about tax rates. So from using a very simple example, from a tax rate perspective, it makes the most sense to amend when you're in a high tax bracket year in a prior year, and you know that you're going to be in a lower tax bracket year in the current year. You want to maximize deductions or reducing income in those high tax bracket years. That's where you can get that's where the largest refund potential exists. So we're 2022 through 2024 high tax rate years. If R&D costs created taxable income at that 35% rate or 37% rate, but you're thinking income in future years in 2025 and going forward under these new rules is going to be lower, maybe there's some permanent tax savings to be had plus some interest. So again, the easiest argument to amend is when you paid tax in the highest tax bracket in a prior year. You know that if you claim a refund, you'll be receiving a refund on income tax paid at that highest tax rate. So then what if you're looking to amend a prior year where income was low? So in some cases, we would see this sometimes where the R&D add back created income from a tax perspective. But without those R&D costs, if you were deducting them under prior to 2022 rules, your income would be much lower. Maybe you're in a break-even situation or a small loss. Well, you got to think about the NOL rules, the excess business loss rules. There's limitations on how much loss you can take in a current year and offset other sources of income. Does it make sense to create carryovers on an amended return that would then be rolled forward to a future year? Work with your tax advisor to see if it makes sense to create losses or increase losses and create some of these carry forwards. Then finally, if you're not amending, again, you can opt to take those unamortized costs in 2025 or split it between 25 and 26. There's an immediate benefit to be had when you're taking those additional deductions in the current year. You're probably, prior to July 4th, you may have been paying estimates based off of prior tax that may have had a built-in increased income for R&D costs. Well, now that we know what the deduction could look like in 2025 and 2026, you might be able to reduce your estimated tax payments for Q4 and hold on to that cash now, expecting that your taxable income is going to be down in the future. And then further, as you're expecting an additional one-time deduction related to these old costs that were capitalized, your income is going to be artificially low, potentially, just all things being equal, with this additional deduction tacked on. Your 2026 estimated tax payments can be based off those prior tax rules and reduce your estimate burden now. So there's a lot of considerations when it comes to just looking at 174 in a vacuum. So multi-year tax planning and modeling these situations, that's what's going to be needed to really maximize these benefits. And again, that key date for amending is July 6th, 2026. And think about extending. If you haven't traditionally extended in years past, now might be a year to extend and take advantage of some multi-year planning, seeing what income's looking like in future years and maximizing some of these tax benefits. So I'm going to turn it back to Vicki to get into some individual provisions.
Thanks, Jamie. So now we're going to discuss some of the significant individual tax provisions that have been impacted. The big one is that the tax rates that were changed with the Tax Cuts and Jobs Act that were previously set to expire on December 31st of 2025 have been made permanent. In addition, the state and local tax deduction that was at $10,000 has been increased to $40,000 for married filing joint taxpayers. There is a phase down, though, beginning with a modified adjusted gross income of $500,000 and fully phasing out at $600,000 of modified adjusted gross income, but it would not go below the $10,000. You would still have the deduction available at $10,000. There was also a repeal of the PEAS limitation for itemized deductions with the Tax Cuts and Jobs Act, and that has now been made permanent. But there is a new limitation that caps the benefit of itemized deductions at 35% for taxpayers in the highest tax bracket. The child tax credit has been adjusted. The non-refundable child tax credit has been permanently increased to $2,200 starting with the 2025 tax year. And the phase outs have been permanently increased to $200,000 and $400,000 for single and married filing joint taxpayers, respectively. And the charitable deduction for non-itemizers has returned, up to $2,000 for married filing joint and $1,000 for all others, effective for tax years of 2026 and beyond. Tax on tips. So eligible individuals will be able to deduct up to $25,000 in qualified tips per year. The tips must be received in an occupation where tipping was customary before 2025. I believe there has been a list recently issued indicating which occupations would be included in customary occupations that receive tips. There is a phase out. The deduction begins to phase out with a modified adjusted gross income of over $150,000 for single taxpayers and $300,000 for married filing joint. And this is effective for tax years between 2025 and 2028. Similarly, eligible individuals can deduct up to $12,500 in qualified overtime compensation per year and $25,000 for joint filers. This applies to the premium portion of overtime pay, so the half in time and a half. It does not apply to the overtime mandated by state or local law. And again, there's a phase out. The deduction begins to phase out with a modified adjusted gross income of over $150,000 for single taxpayers and $300,000 for married filing joint. This could require some tracking on part of the taxpayer or their payroll provider. So you may need to work with your employer and your payroll provider if this is something that impacts you. Deductible car loan interest. There's a deduction of up to $10,000 available on new car loan interest. The vehicle must be assembled in the United States. It only applies to new car loans taken out or refinanced in 2025 through 2028. The deduction does phase out beginning at modified adjusted gross income of $200,000 for married filing joint and $100,000 for all others. And it is available for non-itemizers, so you do not need to itemize to take advantage of this deduction. And the estate and gift tax exemption has been permanently increased to $15 million. And this is beginning in 2026 with inflation increases annually. And lastly, the 1099 reporting requirements have been changed. The threshold for reporting payments to non-employees on the 1099 NEC and the 1099 miscellaneous have been increased from $600 to $2,000. This begins with the 2026 tax year, and it does increase annually for inflation. And the 1099K threshold reverts to the pre-2022 levels and only needs to be reported if they exceed $20,000 and or for more than 200 transactions in a calendar year. However, these are changes to reporting requirements only, so the income does remain taxable and should be included in taxable income. Now I'm going to turn it back to Jamie for some additional planning ideas for some of the new business-friendly tax provisions.
All right, thanks, Vicki. So outside of just the Section 174 considerations we talked about, there's a lot of business-friendly provisions kicking in 2025. 160, the interest limitations being bumped up to being based off of EBITDA bonus depreciation, and that's available whether you're in income or loss position. A lot of new taxpayer-friendly provisions, but the idea is to maximize these benefits. Now, each client's total tax situation is different. And for our flow-through business owners, again, there's permanent tax savings opportunities depending on how these provisions all play together. But all of these new rules kind of play together. They also play together with old rules that all kind of need to be mapped out, modeled out to see how this could impact an amended tax year or how it'll impact your 2025 tax year going forward. So excess business loss rules. So if you're not amending, you know, there's a lot of new deductions are coming your way, especially if you have research costs or if you have a lot of CapEx during the year. Well, back in 2017, when the TCJA came into play, they put into place a business loss limitation. Right now, there's a business loss limitation of 625 grand in the current year. And what's business income or what's business loss for purposes of this limitation? Well, it's K1 income, Schedule E, rental type income, Schedule C, if you have a small business that's just reported directly on your return. Those are the things that come into that business income loss calculation. It's not wages. It's not portfolio income. So what happens if you're over that limit? If you're over that $625,000 limit, anything in excess of that rolls forward to future years and is flipped to a net operating loss. And so when you're creating net operating losses like that, one important fact to know is that an NOL, a net operating loss, can only offset 80% of your taxable income in a given year. So now we're expecting additional R&D costs to be deducted, not only the past expenses, but now in 2025, with the removal of the capitalization requirement, maybe if you created excess business loss, you now have an NOL, you could get an NOL that gets hung up and carried forward to future years. So there's limitations on these losses, and you can't just deduct a large loss against other sources of income. So again, multi-year tax planning will be important. We need to model this out, and that's what will be key to maximizing some of these new provisions. Loss carry forwards aren't always the best option, as there's limitations here. Think about extending. This will give you time to consider these elections and model out what your taxable income might be, and start working with your tax advisors now on different situations, different elective positions, how you want to treat these 174 costs. So outside of just modeling and estimating what your taxable income, maybe there's an opportunity to create income or to accelerate taxable income or delay deductions. So just a few here, a Roth IRA conversion. Maybe you have a tax deferred account and have been thinking about doing a Roth conversion. Well, one consideration when it comes to a Roth conversion is, are you in a lower tax bracket? Now, with a lot of these new deductions and provisions, you might be in a lower tax bracket than you have been in past years. So a Roth conversion, would flip those tax deferred contributions into capital appreciation into income in the current year and convert some of those deferrals into income. And then future appreciation on top of that would generally escape the income tax. So, like I said, with these new rules, maybe there's an opportunity to take advantage of some of those lower tax brackets and do a Roth conversion or a partial conversion and use some of those lower rates. Now, tax isn't the only consideration when it comes to Roth conversions. So work with your financial advisor as there's market considerations, estate planning considerations, all things like that. But one thing to start thinking about is if you're going to be in a low rate, maybe there's a Roth conversion opportunity. So stacking charitable contributions. So charitable contributions are limited to 60% of your adjusted gross income. And that's kind of your, what we call above the line income, income before itemized deductions. So if these new rules are going to bring your income down, your charitables might be limited in the current year and create a carryover to the following year. Well, maybe there's an opportunity to delay your charitable giving to a higher tax year outside of the 2025 and 2026 R&D change window. Now, I know when it comes to charitables, tax is not the primary motivation, but if you think about charitables as, a year-end decision, a lot of clients think about their charitable contributions in December around the holidays. Delaying just 1 month could pull you out of a carryover situation and move some of those deductions to a future year. Bonus elections. So on the capital expenditure side, start reviewing fixed asset additions now, what your plans look like for this year, next year. We know these bonus depreciation rules are permanent. So we're now able to plan for this year, next year, the following year, and do some multi-year tax planning. Maybe there's some CapEx that you're thinking about that's not fully needed. Maybe it's a like to have versus a need to have. Or maybe you want to delay some of those CapEx expenditures to next year and push some of those deductions to future years. Or maybe your additions are locked in, you've already placed in service equipment. Bonus depreciation is the default rule, but you can opt out of that. So there's a little bit of flexibility when it comes to bonus, and you can slow down depreciation to over 5 years, 7 years, 15 years, depending on what the life of the asset is. Just another option available as you consider delaying deductions and accelerating income. So these are just a few of the tax planning opportunities you have. Now that we know what the new rules are, that we know that there isn't a clock on them, start thinking about accelerating income, delaying deductions, and taking advantage of some of these lower tax brackets. Again, multi-year tax planning is really what you need to think about to maximize these tax benefits. And with flow-through income, like a lot of our clients, that's where the opportunities exist for permanent tax savings. So I'll say it again, you can think about extending to give yourself time to plan. There's a lot of good business-friendly provisions here, but the idea is to maximize them. So with that, I think that's the last of our slides, and I think we're going to move into the Q&A section.
Absolutely. Well, thank you both, Jamie and Vicki. That was awesome. I know we got a couple of questions in the chat while you guys were presenting. And, for everyone, if you have any additional questions, please drop them in the chat. We'll jump into some of the ones that were shared with us prior to the presentation. So the first one that we got is, I will end the year with about 100K in revenue, and I'm looking to use this on a work truck. Does the OBBBA offer opportunities to expense an asset like this?
Yeah, so I can take that one. Yeah, so with the new bonus depreciation rules, those 100% rules, yeah, a work truck, that would likely qualify for that 100% expensing. There's rules on business use versus personal use, but that's generally the type of asset that would qualify for the bonus depreciation.
Next one that we got is, with the tax rates made permanent, does this decrease the urgency to make Roth conversions? Should my goal be to convert 100% of my retirement assets to Roth?
So since I'll talk about Roth because I just talked about it. I don't know if it decreases the urgency. Yeah, we know what rates are going to look like in the future. But you don't know what your personal tax situation is going to look like. But as I talked about just a few minutes ago, this might be a good year to do a Roth conversion if you're expecting untraditionally low taxable income. Maybe you're going to be in bracket, a lower tax bracket, the 22% or the 25% bracket, maybe you're going to be in some of these lower brackets that you usually want to be able to take advantage of from a Roth conversion standpoint. So again, tax rates are just one consideration when it comes to a Roth conversion. There's market considerations. You really want to work with both your tax advisors and your financial advisors when it comes to the amount of a Roth conversion, if you do it all, if it's partial, and what the best outcome would be for you.
I'm going to share one that's from the chat. How does the bonus deduction change purchase of vehicles under 6,000 pounds for small businesses and if it is partially used for personal use?
I don't know that it does change. There's still limitations applicable to autos under the 6,000 pounds. And there would be bonus allowed, but it's not going to be 100%. There's going to be limits on that. So we would need to look up what those limits are per year. And then as far as personal use versus business use, then you'd have to prorate your depreciation on that as well. And I think you need to use it at least 50% for business in order to take depreciation.
The next question that we had from the chat is, I am confused about the 1099 rule. So a company doesn't have to issue a 1099 unless the contractor makes 2K or more, but the contractor still needs to claim anything more than 600. She said something about the amount was increased, but it was still taxable, and that confused me. Thanks.
Yes, so you do not, if it's a 1099 NEC or 1099 miscellaneous, you do not need, the company does not need to issue the 1099 unless they meet the $2,000 threshold. However, the rule is still that they need, if they're earning income, they need to report that as taxable income. They should be reporting that as taxable income, whether they receive a 1099 or not.
Okay.
No, those new rules, the $2,000 limit that kicks in 2026. The $600 limit this year, and yeah, it doesn't matter what income is reported. The general rule when it comes to reporting income on your tax return, you're supposed to report income from whatever source derived, whether it's reported on a 1099 or not.
We have a couple other questions in our slides here. Is the $40,000 SALT cap a permanent change like many of the business tax changes mentioned?
No, that is actually set to revert back to 10,000 in the year 2030.
We have another one in the chat. Does the OBBBA have other impacts on my payroll taxes?
So on the payroll side, I would say, the W-2s, if you have employees who earn tips or overtime, there's going to be some additional reporting on the W-2s. So the employees know what their non-taxable tips are or non-taxable overtime pay is. They've already come out with some draft forms on what it's going to look like at the individual level. So your payroll provider might be asking you for additional details when it comes to that type of pay. But outside of that, there aren't many significant payroll type changes.
All right. For the new 100% bonus depreciation discussed, what if I purchased equipment prior to the 1/20/25 date? Will this still qualify for a 100% bonus? Ooh.
Yeah, so you might be wondering about the 1/20/2025 date. That bonus depreciation date was tied to President Trump's inauguration date. But if you purchase equipment prior to 1/20, and if you have a binding contract, if there's penalties for breaking the contract, or something significant where it's a binding contract, then no, that would not qualify for the 100% bonus rules. It's got to meet two criteria. You can't have a non-binding contract date prior to 120, and then it has to be placed in service after that 120 date.
The next one that we have, a lot of tax provisions discussed today, you mentioned were permanent changes. Does this mean that Congress cannot change the law in the future with these items?
No, these are just it means there's no current expiration date, but new laws could be passed.
Okay.
But as of right now, they are permanent. There's no current expiration date for those ones that are permanent.
Okay. Well, thank you guys. These are all the questions that I have received so far. If anyone else has any other questions, please feel free to, send them our way. But with that, I think that we will hop off. Thank you guys so much. This was fantastic. I really appreciate you, sharing all of this information on the OBBBA. For everyone else out there, we will send out the slides, recording, and an extra resource after this presentation. So thank you, everyone.